Gold didn't just pull back, it collapsed. In a single session, gold suffered its largest daily drop in 4 decades. Silver saw the biggest intraday plunge in its history. This wasn't a normal correction. It was a violent unwind of one of the most crowded macro trades on the planet. And the trigger wasn't inflation data. It wasn't geopolitics. It wasn't China. It was the Federal Reserve and credibility. For most of the past year, investors weren't just buying precious metals. They were buying a narrative. Fear that the Fed was losing independence. Fear of currency debasement. Fear that politics would override discipline. Gold became the hedge against institutional decay. Then the narrative cracked. When reports confirmed that President Donald Trump would nominate Kevin Warsh as the next Federal Reserve Chair, the dollar surged, and the metals trade broke. Not because Warsh is dovish, but because he isn't. Warsh has a long-standing reputation as an inflation hawk. He opposed quantitative easing during the aftermath of the financial crisis, blamed inflation on money printing and fiscal excess, and has warned for years about the dangers of an oversized Fed balance sheet. Markets didn't hear rate cuts. They heard something far more important. Even a Trump-era Fed would rather shrink the balance sheet than sacrifice the dollar. That single signal was enough to detonate a trade that had become structurally unstable. Gold didn't just fall because the news was bad. It fell because the plumbing broke. For weeks, prices were being driven higher by a massive gamma squeeze. Investors piled into call options. Dealers who sold those options were forced to hedge by buying futures as prices rose. That buying pushed prices higher still, forcing even more hedging. It was a self-reinforcing loop. When the Warsh news hit, that loop slammed into a wall. Dealers didn't just stop buying. They had to aggressively dump futures to stay neutral. This wasn't panic. It was mechanical execution. What had powered the rally turned into an accelerator on the way down. That's why the move was so violent. Gold fell from near $5,600 an ounce to below $4,900 an ounce. Silver collapsed from around $120 into the 80s. Psychological levels didn't matter. Support didn't matter. Narratives didn't matter. Positioning did. This is the key point most people will miss. Investors weren't just long gold. They were short the Fed's credibility. Gold wasn't a commodity trade. It was a political hedge. The Warsh nomination signaled that the debasement at all costs thesis had limits. The collapse of the dollar narrative didn't die. It got postponed. And in a parabolic market, postponed is the same as over. Once that realization hit, the hedge had to be reduced. That's why this wasn't the end of a bull market. Even after the crash, gold is still up double digits for the month. That tells you how distorted the setup had become. This was not a change in long-term math. It was a margin call for late positioning, and it changes how this market trades going forward. Gold is no longer just a safe haven. It's a volatility instrument. It now trades on credibility shocks, dollar swings, positioning, and balance sheet expectations, not just inflation prints. That means the roller coaster isn't finished. This is what happens when markets stop trusting narratives and start reacting to structure. The Fed didn't just move metals. It exposed how fragile the global hedge trade had become. This is Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.